Hi, everyone. Thank you so much for joining us here today for this seminar, Behavioural Alpha. I'm Zoe, the president of the Behavioural Innovations team. We're really happy to deliver this event in collaboration with the FinTech Society, so I extend an especially warm welcome to all of you. Essentia Analytics, of which Clare is the CEO and founder, combine AI and behavioural science for undeniable improvements in portfolio manager performance. At Essentia, they are shaping the intersection of our fields, so I encourage you to take the opportunity to ask questions in the Q&A as they come to mind. After the presentation, you will have the opportunity to ask those questions to Clare. Thank you, Clare, for coming today. I'm sure that I speak for all of us when I say that we really look forward to hearing what you have to say. So let the presentation begin.
Great, thank you. So welcome everyone. And as you've heard, my name is Clare Flynn Levy, and I'm the founder and CEO of a behavioral analytics company called Essentia Analytics. What we do at Essentia lies at the intersection between behavioral science, AI, and investment decision-making. So I'm going to touch on all three of those themes today. And I'm going to start by talking a little bit about AI and the impact that it's having so far on the asset management industry. So the asset management industry is ripe for the use of AI. It is an extremely slow-moving industry, as those of you who are FinTech fans are probably aware. I was actually a fund manager, in an active member of that industry from that angle, from 1995 to 2005. And now that I work intimately with other fund managers at 30 odd firms around the world, I can say conclusively that very little has changed with regard to how they work in the last 15 years. So an enormous amount of what goes on in the asset management industry still today depends on human judgment. And thus, according to this chart, which is looking at, the extent to which a given industry's dependence on human judgment versus machines diverges from the average industry, asset management has the biggest gap. It did in 2016 anyway, but I can tell you not a lot has changed on that front. So what do we mean by AI? It's a term that gets thrown around a lot. And I personally like to think about AI as being a continuum, from at one end of the spectrum, assisted intelligence, and at the other end, autonomous intelligence. Assisted intelligence is about basic task automation. You might think of it as the fuel light on your car's dashboard. In the middle of that continuum, you have augmented intelligence. I like to think of that as the lane assistance feature that you might see on more modern cars. If you've bought a car at all recently, then you know what I'm talking about. And if you don't, you probably don't. But cars have come a long way. And there's a lot of cool new augmented intelligence features involved these days. Usually when people are talking about AI, they're talking about autonomous intelligence, where computers are making all the decisions and can even program themselves. But that's not, that's not the whole of AI. That's just the very sexiest end of it. So the active fund management industry, and by that I mean the part of the fund management industry in which humans or machines are making proactive investment decisions as opposed to just following an index. That active fund management industry has been disrupted by index funds. And index funds are dumb in that they don't make a lot of decisions, and they're cheap. And to the extent that you believe that active fund managers can't perform index fund or can't outperform index funds net of their fees, then index funds present a more compelling value for money choice. Now, at Essentia, we would disagree with that point. It's not necessarily the case that they can't outperform net of fees. It is the case that they haven't historically, but I'll come back to the difference between those two things. But if you believe that it's the case that they don't anyway, then a logical conclusion might be that humans should be replaced by machines in investment decision making. Machines are cheaper, they're resilient, and they're unbiased, right? Yeah, right. Except it's not as simple as that. First of all, algorithms are biased by the humans that write them, and we've seen lots of evidence of that in the press in recent years. Autonomous intelligence, where it works, is good at solving small world problems like ordering pizza or booking appointments, things that benefit from the solving. But it works where there are clear rules and a discrete number of options and a limited amount of complexity. Unfortunately, investment decision-making is a large world problem. It's highly complex. There's a high degree of uncertainty. The participants are changing the entire time. So it's really not the lowest hanging fruit by any stretch for AI in an autonomous intelligence kind of way. There are quant funds out there that are using AI and experimenting with it and have been for a long time now. But most of them are only using it for specific tasks within the overall investment strategy, as opposed to just letting an AI loose on inventing its own investment strategy. The latter is just something that the industry is not ready for yet, not least because of the inability of humans to understand why the AI is doing what it's doing when it's creating its investment strategy. The lack of narrative is problematic for investors to get behind, which, yeah, I think we will see in a lot of other ways as time goes on as well. But, autonomous intelligence is developing at an exciting pace. It's got a long way to go. And this Facebook post is from a friend of mine back in February, and it's sort of case in point. An autopilot failure in her Tesla caused her son to get into a massive accident on the motorway, and he was fine, thankfully. But it's a reminder, these things are not perfect. The stakes can be very high. It's early days. And so, putting too much faith in autonomous intelligence too early is a dangerous thing to do. But as you've seen, that's not the only option. There is augmented intelligence and, of course, assisted intelligence, which we've all been using for a long time. Investment decision-making is still ultimately all about human judgment. We've seen an explosion of software and data vendors using AI to help investors get better information about the companies they care about. I call them next-gen research tools. And this is just a sample of some of the ones that I've come across in my travels. They're generally either about processing more information faster or about crowdsourcing estimates, earnings estimates, or about quantifying market sentiment, or making it easy to search across data sets and reference historical patterns by way of comparison to whatever's happening today or could be happening tomorrow. Those are all pretty interesting things, and the tools are very cool. They've made it possible for analysts to not have to do quite so much of the grunt work. Then it's about the human using their brain to think about what question they're trying to answer, as opposed to doing all of the data scouring themselves. So probably a much better use of the human, and the human appreciates it. Ultimately, they're all about helping a professional investor know which information is worth paying attention to. It's a valid point. But it's important to note that what we're talking about there is information about other people's behavior. whether those people are consumers or companies or other market participants. And other people's behavior is hard to predict, especially other investors' behavior. After all, the data that is used to make predictions about the market is based on investors from the past. It's not the same people. The market's composition of participants is not remotely the same today as it was 10 years ago or 20 years ago, much less longer. So there's only so much predictive power that you can really put in that old data. And if 2020 has taught us anything about the stock market, it's that events we have never experienced before can send it moving in unpredictable ways. That concept comes with the territory if you're a fund manager. Everybody knows that the market is ultimately not predictable. And yet you're just trying to get slightly in front of everybody else in getting it right. At best, it's a very noisy place, the market, from a data point of view. And predicting it is extremely difficult. But there is much lower hanging fruit out there that most people are ignoring. A far more stable and predictive data set than any market data or consumer data you could ever look at is the past behavior of one person, whether that's a human or even an algorithm programmed by a human. An individual market participant exhibits behavioral patterns that are very consistent over time and that tend to only really ever change if the market participant deliberately changes them or if some exogenous factor affects that person's decision-making in a significant way. So if you are a market participant, if you like to invest in your spare time, I have great news for you. You can control your own behavior. You cannot control the behavior of the rest of the market, but you can control your own. And that's exciting. I want to talk for a minute about just a little bit of background about what a fund manager's job is, because I'm conscious that not everybody on this call has had exposure to the fund management industry. A fund manager's job is to make good decisions day in and day out with his or her client's capital. And some of those decisions are stock picking decisions. And I'm focused on stocks, but this is as relevant to other asset classes as it is to stocks. But the point is, they're making decisions about which thing should I own. Should I own Amazon or should I own Marks and Spencer? And they're making a lot of implicit decisions not to own a lot of other things. They're also making, though, a set of timing decisions. When should I own it? When should I start buying it? How quickly should I build my position? Should I add and trim it at certain points? How quickly should I get out of my position? And when should I get out of my position? And they're making decisions around sizing. How big should this position be at the various stages in its life? So, that's a lot of different kinds of decisions. And then if you add to that the fact that they're making even more decisions every day, both implicitly and explicitly, that don't result in trades, it's a lot. And yet, that's the fund manager's job, to make good decisions. Is every fund manager good at every different type of decision in every different context? Probably not. Why would they be? They're human beings. That would be an unreasonable assumption. And so what we do is we take what we call a trading episode as a fundamental measure. So we're working with historical trade data and holdings data for the sake of reconciliation, but all the trades that somebody's ever done, and then we're assembling them into episodes or game tapes, if you like. So this is an example where this is over time on the x-axis and the quantity of this position held on the y-axis. So at this point, this fund manager has decided to enter this position, to buy this stock. So they have an entry point. Then they have a period over which they are scaling into their position. They might, wade slowly into the water, or they might cannonball it and, make a big splash. Who's to say which one of those is the right thing to do? It just depends. But different people have different habits around scaling in, and sometimes explicit rules that they like to follow in how they do that. They very rarely test whether that rule that they're applying, whether they're doing it intentionally or not, is actually the optimal way of doing it. And that's, of course, where we come in. You also have a scaling out period when you're on the way out of a position, and you have an exit timing point, a day when you finished selling out of a position. And then in between, you've got a sort of adding and trimming period. So what we do is we assemble this game tape, and then we zoom in on each type of decision in the same way that, if you were Roger Federer's coach using data analytics, you would zoom in on his serve, his forehand, his backhand. It's the same idea. And that is how we, effectively are turning fund managers into elite athletes, but just by giving them a data-driven feedback loop. So today, if you ask a fund manager, in what circumstances do you make your best decisions? And which types of decisions are you the best at making? They probably would have to admit that they have no idea. They might have hunches. A lot of the fund managers I speak to think that they know the answer to that question, but they can't really prove it. And it's very hard to change anything if you haven't got some kind of data proof to base that change on, at least if you're a fund manager. And yet, if you don't know the answer to that question, then you really can't play to your own strengths. You can't avoid your weaknesses or minimize them at least. You can't maximize your return on energy expended, which is, I've made that that term up, but it is the same idea as return on capital, except your capital as a human being is, intellectual energy, emotional energy, physical energy, psychological energy. You want to deploy that energy into things that are going to give you the best possible return. And that return might be measured as happiness or some non-financial measure. But if you're a fund manager, it's a financial measure. You want to spend your 24 hours in the day, smartly invested on the things that are going to make you the most money for your investors and for yourself. So maximizing return on energy expended is ultimately what it's all about. You also have so much data, right? More and more data every minute of every day. How do you even know which data is worth paying for, much less focusing on? And how can you ever engage in continuous improvement? A lot of fund managers are naturally continuous improvers. They like to do triathlons, and they wear Fitbits, and they use Strava and all these apps that are about continuous improvement in a health and fitness realm. And yet they haven't had the ability to apply that same sort of cycle to their day job until now. But at the end of the day, the big one is that they can't prove their value add to investors if they can't connect the dots between the decisions they're making and the outcomes that they're generating. It seems really obvious, and yet they're flying blind without this. And so we shouldn't really be too surprised that they haven't been outperforming randomness, But what if they weren't flying blind? What if they could actually answer these questions? That might change things. So you might ask, how have they even been operating all this time without a data-driven feedback loop on the quality of their investment decisions? And the answer is that they've been focusing on performance as a measure of skill. Not just them, but their end investors have been doing that too. And that's despite the fact that the fine print on every single ad for any investment product you'll ever see says past performance is not predictive of future. It's funny that, isn't it? That that's what the ad says. And yet literally the whole industry just looks at past performance and says, oh, this is a good fund manager and that's a bad fund manager. And very few of the fund managers in question or the products in question have a long enough track record to really make it possible to say that that past performance is predictive of anything. So we're sort of stuck in this blind loop, which really doesn't make any sense. The reality is that performance is not a measure of skill. It's a measure of outcome. It's a function of skill. And if you believe that there is any skill in investing, then it is a function of skill, but it's also a function of luck. And luck does play a very large role in it. You can't do anything about the luck part, right? I mean, that is what it is. And over time, you would expect it to even itself out so that any one investor is not likely to be more lucky than another over a long period of time. So all you can really do is try to maximize the skill piece. So what does that mean? Well, the way we look at it, skill is a function of the conscious decisions you make, which are characterized by your investment process and the discipline with which you apply that process, and the unconscious decisions you make, which you might characterize as behavioral biases. But also intuition. There's a lot less work, it would seem, in the field around intuition than there is around bias, but these are two sides of the same coin. The point is, the more you know about the decisions you're making unconsciously, and the more you can pinpoint which ones are happening, for the right reasons and are resulting in good outcomes, and which ones are not, the better off you're going to be. So an investor's job is to just focus on maximizing skill, maximizing the efficiency of their process and the discipline and consistency with which they apply it, and maximizing or minimizing the negative effect of the unconscious decisions they're making on the portfolio. And ultimately, the only thing an investor can control is his or her own behavior. I mean, that's kind of same goes for every single one of us. That's the one thing we can control. So fine, let's control it. And so this is what we do at Essentia Analytics. We help professional fund managers make measurably better decisions by combining technology with expert coaching and the concept of nudging. And in doing so, we help them generate what we call behavioral alpha. Behavioral alpha is the excess investment return, or alpha as we like to call it, over and above a benchmark that results from mitigating the biases hidden in your own decision-making process. It's not a term that you will have studied in your degree yet, but this is the new frontier of alpha generation in asset management. It used to be that you could make, you could outperform everybody else by being smarter than them or having better information than them. These days, I hate to say it, but there's a lot of smart people out there, and there's a lot of information, and it's getting cheaper all the time. So it's very hard to have a competitive advantage through either one of those. But almost bizarrely, you can have a competitive advantage just by looking in the mirror and being more honest with yourself and getting out of your own way better than other people do. Which is pretty simple, really. And yet there are lots of reasons why everybody doesn't already do that. We can talk about that in a minute. But what we're actually doing is our customer is a portfolio manager or an analyst, and they're sending us data about their historical trading decisions in the first instance, and then sending us trade data on an ongoing basis as well. And we're uploading that into our system. We're running a whole set of diagnostics on it. A bit like going to the doctor and getting your blood work done. And then we're delivering the results of that blood work to the fund manager once a quarter over a human meeting, a human, which we call an insight partner. And it's, importantly, it's somebody who has been a fund manager before. So has sat in the seat and just appreciates the trials and tribulations, the empathy factor. It makes it easier for the fund manager to internalize the information that's being shown to them when somebody that they respect and identify with is delivering it to them in an objective way. And so hopefully they take the learnings from those sessions and they put them to work in their ongoing decision making, and around we go. Except that it's not as simple as that, because people just, they don't work like that. If you go to the doctor and they do their blood work or your blood work and they hand you the results and then they say, okay, so see you next year. Even if they told you you need to stop eating so much red meat, are you really going to stop eating so much red meat? Maybe, probably not. People have a tendency to be very stubborn in their patterns, and they don't do the right thing if you leave them to it. So it's not enough to just sit down with them once a quarter and have this conversation. They need something on an ongoing basis to help them remember what they've learned. And that's where this concept of nudges comes in. Now, I use the word nudges in a different way to the nudges that you've been reading about if you've been doing behavioral science courses. Inspired by that, yes. But when we talk about nudges, there's nothing subtle about it. These aren't sort of little background ways of herding people in one direction or another without them necessarily even realizing it. This is literally a tap on the shoulder. Well, maybe not literally, it's an email or a text, but it's a notification that prompts the fund manager to shift their brain into system 2. So if any of you on this webinar have read Thinking Fast and Slow and know the work of Kahneman and Tversky, then you know the difference between system 1 brain, which is sort of passively making decisions and you're not really thinking about it, and system 2 brain, where you're actually like mentally engaged, critically thinking, making it a conscious decision. And so what we use a nudge for is jogging the portfolio manager's brain into thinking a little bit harder about the decision that they're about to make implicitly. And we do that by having them be reminded of questions that they told us they wanted to ask themselves the next time they were in that particular situation. That piece of it is very interesting, and I'll come back to it. But the idea is that the portfolio manager is talking to himself. The nudge is just a delivery mechanism, but it's about holding yourself accountable in your own words. And as somebody who's done quite a lot of nudging of myself, I can tell you it's way more effective than if a computer tries to tell you what to do, or even another human that you really like. Something about ultimately only having yourself to answer to that people respond to. So that's worth keeping in mind for lots of other purposes, I'm sure. So when we're analyzing this data, what we're doing, I mentioned before, is we're taking trading episodes and decomposing them into the constituent types of decisions that are being made. So picking decisions, entry timing decisions, scaling in decisions, sizing decisions, size adjusting decisions, which is a little different. Sizing decisions saying, here's how much of my portfolio I want to put in a certain stock. And size adjusting is all the adding and trimming I might be doing at the margin. And then I could separate my adding decisions from my trimming decisions, and look at my scaling out decisions and my exit timing decisions. So this is the blood work that we're doing. And we're asking the question, in what circumstances does this fund manager exhibit consistently skilled or consistently biased decision-making behavior in the same way that, an athlete would be looking at the stats on their batting average and their slugging ratio and whatever else. It's just about where do they get it right more often than they get it wrong, and where do they get it more right on average than they get it wrong when they get it wrong. These are the key measures. We call it hit rate. That's your batting average. If I realize I'm using baseball metaphor or analogy, which is not necessarily the ideal, but so be it. You want to be getting it right more than 50% of the time. But you could get it right less than 50% of the time, as long as when you do get it right, you get it really, really, really right. And when you get it wrong, you only get it a little bit wrong. We call that your payoff ratio. So the average outperformance of your outperforming positions divided by the average underperformance of your underperforming positions. Somebody asked in the Q&A, what is alpha? So alpha, as we're talking about it here, is the excess return over and above a benchmark. So if your benchmark is a FTSE 100, then how much money has your investment portfolio made over and above that? When we talk about your payoff ratio and you're somebody who runs a portfolio relative to the FTSE 100, then we're interested in how much have the positions that you've held that have outperformed the FTSE outperformed by versus the positions that you've held that have underperformed the FTSE underperformed by. So hopefully that makes sense, but if not, feel free to ask again. At any rate, what we're doing is we're identifying patterns in these different types of decisions, and then we're connecting these patterns to biases, at least in terms of trying to understand them. And I imagine that most people on this webinar have some awareness of the field of behavioral finance. I am, you won't be surprised to hear, a big fan of it. A big part of what we do at Essentia is applying the learnings of behavioral finance to real life decision making. But as a former fund manager myself, I think it's very important to point out that there is not a one-to-one mapping of biases to trading behaviors. And to even try and get that deep into it is missing the point. We hypothesize that different patterns are the result of certain biases, but ultimately what matters is the pattern. If we can understand some theoretical reasons for why we do it, it makes it easier for us to forgive ourselves, not beat ourselves up so much, and explain it. It gives us narrative, which we crave. But ultimately, what we care about is the pattern and how to stop committing it if we are committing that pattern, and if we feel that pattern is detrimental to our performance. So I'm going to show you a few different examples of what that looks like. The first one is about loss aversion. This is probably the most well-known bias out there, the most all-encompassing maybe. And we are hardwired to avoid loss. Here's what this looks like. Here's what loss aversion looks like in exit timing behavior. So what we're looking at here is an analysis of a given portfolio manager's exit decision making in the context where the price has been moving against him or her. Okay, so there are several different methodologies that we apply to understanding exit timing, but in this case, what you're looking at is an event study where we consider a window, in this case, of 60 days prior to the exit point and 60 days after the exit point. And we do that for every single exit that this fund manager has ever made. The line here is the relative price, so the price, you could think of it as just the price, but it's the price relative to the index because we're talking about alpha. But the price of the median one of the stocks that this manager has exited into a falling share price. And it's showing you in the run up, it's gone down by 6.4%, so underperformed by 6.4%, which wouldn't necessarily be a terrible thing if it kept going down by even more than 6.4%. By definition, these are going to all be stocks where the price was going down before, because we are looking specifically at stocks that were exited into a falling share price. But what happens after matters a lot. And you can see in this case, it doesn't keep going down by more than 6.4%. It goes down by a tiny bit more. So this fund manager is capturing most of the near-term underperformance in these shares and then capitulating at the bottom. And it's too late by that point. Every fund manager has done this before. So it's not like, this is only dummies that do this. It's very, very common. It's the most common behavioral pattern we see. And we associate it with loss aversion, because there is this tendency to hope that it's going to stop falling. I'm going to get a better day to get out of this, right? And somehow that just doesn't end up happening. And then you say, enough, I felt enough pain, I'm out. And then sometimes you see a V shape, where it bounces afterwards, which is, that's the worst when it happens to you. Luckily for this person, that's not his pattern. Another example is around the fear of future regret, which is a huge one for fund managers. And what this looks like is the holding of a lot of small positions that are detrimental to performance. So now this is a fund that thinks about position size in terms of overweight and underweight relative to an index. So it's starting, say, with the FTSE 100 as its reference point, and then saying, all right, well, I want to outperform the FTSE by a certain amount every year. So, but I don't want to underperform it by more than a certain amount. So I have to do everything, make all of my decisions with reference to the FTSE. So when I have a large overweight position, that means I'm taking a much bigger bet than what's in the index. And you can see here, this person is making all of their impact. So impact being the contribution of the relative outperformance to the portfolio. So sort of the sum of all outperformance divided by the amount of assets under management is a sort of simple way of looking at it. All of their impact is coming from their large overweights, and yet they're giving up more than that in their medium and small overweights. So what, begs the question of why is it that nearly 2/3 of your trading episodes have been in these tiny little overweight positions? Why do you have tiny little overweight positions? And usually the fund manager will say, well, my conviction wasn't strong enough in those, I shouldn't have them probably. Or, I buy them to protect myself, because what if those stocks then do outperform and then I'm wearing it performance-wise, because I'm being measured relative to the index. But that fear of being hurt by not owning it can end up destroying all the gains that you're making with the bets that you're taking that are what we call active bets. It totally defeats the purpose. Another example is around this need to act. This we associate it with overconfidence, but there's a tendency for some fund managers to overtrade, to make a lot of adding and trimming decisions that don't actually add value. And this isn't as common as the first two patterns I showed you, but you see it more often in hedge funds than in long-term investment strategies. But in this case, what we're looking at is how the portfolio would have performed if the portfolio manager hadn't done any adding or trimming of positions. If they had just bought on the day they actually entered, gone to the actual average position size that they did, held it, and then exited it on the day that they actually exited, and not any of the buy, sell that sometimes people do. And what it's showing is that in 66% of this person's trading episodes, their adding and trimming decisions destroyed value. Often it is the case that a portfolio manager feels like they know particularly their largest positions, and that's where this person has been doing the most damage. They know these positions really well. They've held them for a long time. They've been trading them for a long time. And maybe they've got some intelligence that they think they know more than the market about. Sometimes it is the case. Sometimes that looks the other way around, and you can prove that some of these adding and trimming decisions do add a lot of value. And so therefore, investors, who may assume that adding and trimming is a bad thing are not necessarily right about that. For most people, it's a value destructive thing, but not for all of them. And for the ones who make money at it consistently, the ability to prove that is hugely valuable. I'm going to just go through one last example here. It's about overstaying our welcome. And that's something that we attribute to the endowment effect. So the idea that you overvalue something just by virtue of your own ownership of it. So this is looking at what we call an alpha life cycle analysis. And it's basically looking at the way that the excess return, the alpha, in any position that a given portfolio manager puts in the portfolio, how that alpha accumulates over the life of the position. And then we're looking at that across every single position they've ever held and saying, is there a point at which this person's ideas tend to run out of steam in terms of the alpha they generate? Is there a point in the evening when it's time to leave the party before the birds are singing and there's people lying on the floor? There is a point when you should leave, and it's not always the point when you do leave. But if you could analyze every party that you ever went to and find that point and then get nudged at that point the next time you're at a party, you might make a better decision. And that's basically what we do here. For this person, it's not so much that their investments go up and then go down, but rather that they start to run out of steam around here. This is sort of 3 years in. This is obviously a long-term investor. But after 3 years, this person's ideas stop generating incremental alpha. So if nothing else, it would make sense to redeploy that capital into fresher ideas that are, more on the accumulating end of their lives. And this resonates for a lot of fund managers, because particularly when a stock has been making you a lot of money, the tendency is to fall in love. You get to know the management team of the company really well, and you go to all of their meetings, and you follow everything they do, and your conviction level is super high, and it has been for the right reasons. But there will always come a point when the cracks start to show, or even just it stops moving as fast, and you don't necessarily realize it as soon, because you're not asking the same sort of questions that you would ask of an investment you weren't already in love with. And so what happens is, you overstay your welcome. Before you know it, the birds are singing and there are people lying on the floor. And hopefully you're not one of them. But we did a study across a whole bunch, 43 different portfolios over 14 years, and looking specifically at this concept of the alpha life cycle. And we found that 4 different profiles emerged. I won't go into detail on those here, but at the end you'll see a link to, or you'll see my URL. We have white papers on this, lots of free research that you can download. So there's a whole paper about the alpha life cycle, and I recommend, if you're interested in it, that you download that. But the most common, most prevalent profile that emerged was what we call the round tripper, the inverted horseshoe. So this is looking at the impact of a given position on the portfolio during its life, so over time. And what we found was that on average, portfolio managers were generating pretty significant alpha each year at the portfolio level during the first half of the position's life, but then they were giving it all back in the second half. And, saying to a portfolio manager, well, okay, so your peak point historically has been here. So therefore, every new investment you make, you need to get out at this point. It's very easy to say that in hindsight, but when you're in it, it's not so clear. What we found, though, was that you don't have to pick the exact top. You have an average, or these portfolio managers anyway, had an average of 6 months in which to make the decision to get out in order to preserve 120 basis points of excess return. So just forget the yellow box and assume that you'll never be that perfect. You still have quite a long time to preserve 120 basis points, so 1.2% of outperformance per year. But when people talk about how fund managers can't outperform net of fees, the fees are way lower. The difference between an active fund manager's fee and an index fund's fee, it's maybe 75 basis points, 0.75%. So they can outperform net of fees if they could stop doing that, and that is then where nudging comes in. It's an example anyway of where nudging comes in. So in this case, what we do is we find that historical peak alpha point for each fund manager, and it varies, between different portfolios. But once we've identified it, then we scan the portfolio on a continuous basis for all the positions that fund manager is holding that have hit that point. And then we send them an email that says, here are all the names in your portfolio that have hit that point. Click here. It doesn't mean you have to exit those names. It just means you have to click here. And when you click here, it's going to ask you some questions that you said you wanted to ask yourself the next time you were in that situation. And this is what I mean about prompting engagement of the system to brain. If there's a position in your portfolio that it's been doing pretty well, it hasn't started underperforming particularly, so you're not focused on it. You're just holding on to it and implicitly making a decision to own it every day. But if you stop and ask yourself, would I be a buyer of this today if I didn't have any? That's a different question. And it might lead you to decide that no, you wouldn't be a buyer today. And in fact, if you wouldn't be a buyer of it today, then why are you even in it? Do you have a better idea somewhere else? It's then up to you what you do. Maybe you say, yes, I would be a buyer today, in which case you're going to double up. Or maybe you decide, well, I wouldn't, but I'm going to stick with it for the time being. Whatever, do what you're going to do. But the point is that you had this conversation with yourself, and it's now been marked in the data that you did. And then we can see what happens next. We do something similar with the loss aversion example, where we find, where is a point historically where it would have been optimal for this person to make a decision to exit or to sometimes to double up. Again, it varies by portfolio. So there's no one size fits all answer, but what we do there is analyze the portfolio on a, ongoing basis. And then once a week, we send them an email that says, here are all the positions you're currently holding that are behaving like this. And you said you wanted us to ask you these questions. And same thing, just click here, ask yourself the questions and engage, system 2. Again, you can do whatever you want to do. You can ignore this if you want to, or you can act on it, or something in between. But the point is then afterwards, we can measure the hit rate and the payoff on the trades that you make on the back of these nudges versus your normal trades. And what we find is that the hit rate and the payoff on trades made on the back of nudges is higher typically than people's normal hit rate and payoff. So using their system 2 brain is actually causing them to make better decisions, which is pretty cool. And here's what the before and after looks like when you're talking about loss aversion examples. So before, he was giving up 6.4% of relative performance and capturing all of the near-term underperformance. Here, he's still capturing some underperformance because you'll recall, we are looking specifically at the stocks that he exited into a falling share price or an underperforming share price. But at least it keeps going down afterwards. At least the underperformance is almost as large as the underperformance after is almost as large as the underperformance that he captured before he exited. So that marks an improvement in this person's exit timing. So this is what we mean about behavioral alpha, this idea of if you can help somebody stop making the same mistakes over and over, you can help them generate significantly higher returns. And we found that 75% of the clients we've worked with, once they've been with us for a year, because it takes some time to change behavior and to get people to embed this into their existing investment process, but 75% of them do increase their annual alpha generation on the back of working with us. And on average, they're doing it by 170 basis points. So 1.7%, which if you're not from the finance industry, probably doesn't sound like very much, but to a fund manager, this is huge. Now, if you're running billions, I mean, altogether, our client base manages about $200 billion of assets. So if 75% of them can improve their alpha generation by 170 basis points per annum, that equates to 225 million of pure profit that we're helping them deliver to their investors. And, they charge fees on that, so to themselves. So why, you may ask, does everyone in the world, why doesn't every single professional investor in the world do this? Good question. This is a man called Ray Dalio, who, if you're involved in the investment management industry, you'll be well aware of, but if you're not, probably never heard of. He is the manager of the world's largest hedge fund, Bridgewater Associates. And he puts it well, I think, when he says that the biggest problem that humanity faces is our own inability to look in the mirror and to recognize our own strengths and weaknesses. We're just naturally resistant to it. And yet, as Dalio himself has proved with his fund, being prepared to go there is a competitive advantage. Whether you're a professional investor or a professional athlete or anyone else who's doing a skill activity, if you want to continuously improve, you need a data-driven feedback loop on the thing that you're doing. And Ray Dalio has put that into place very successfully at Bridgewater. Now we're bringing that to every other fund manager who is open-minded enough to have that conversation in the mirror. So with that, I'm going to take some questions, show you also, here's some of the books that I have mentioned in this talk, not by name, are listed here. If you haven't read all of these, I recommend them. I imagine some of them you've read already. We also do have a book list on our website, which you can find here. And we have lots of white papers and interesting blog posts and that kind of thing. So please feel free to head on over there and download to your heart's content.
Thanks.
So there I are. Okay, great. Thanks, Zoe.
Yeah, thank you so much, Claire. It's really interesting. I don't know if anyone thought they were going to get a data-driven partying approach delivered today. But certainly be fun. So I see Trang has put a question in the chat. So Trang, I'm just going to unmute you and let you ask your question to Claire.
Hi, Claire. Thank you for that. That was very informative. How do you account for emotions and or, let's say, interoceptive awareness into the decision-making process? Do you account for that at all in how it might influence cognitive biases? Is that a factor in your analysis?
I mean, I think that's a very interesting piece of the puzzle, and it's a tricky one when you're dealing with fund managers because they are typically some of the least emotionally aware people that you might come across. Or they've been taught that being emotional is bad and that emotions are bad and therefore don't have those, and it's like, that's a ridiculous thing to think, that you could not have them and still make decisions, right? The science has proved that. So it's a slowly process that we go through with them, whereby we show them the pattern and then we show them the individual situations where they've got themselves into that pattern. And then we say, okay, we want to start you journaling. And we're not going to call it a journal because that's like maybe too scary of a term for you. Or a diary. God help us if we call it a diary. We're going to call it a brain dump. And once a day, we're going to nudge you to dump your brain. And we're going to ask you some questions. And some people get it first thing in the morning. Some people get it last thing in the evening. It's up to you when you want to do it. But some of those questions can be about your state of mind and your emotional state. And if we could get them to start answering that kind of information, it creates a time series of data. It's not necessarily the case that you can connect, just because at 8 a.m. this morning, I felt highly confident. It doesn't mean that when I did a trade at 4 p.m. today that I still felt highly confident. So, it's not the necessarily the most precise predictive thing. But what you can do is show people, all right, well, on days when you woke up feeling like this, here's how you tended to perform. Here's how the decisions you made that day tended to turn out. And you do find patterns in that. And so once you start showing them that, you're sort of opening their mind up a little bit more to thinking about how their emotional state is affecting their decisions. But the first trick is to get them to even answer the question. And then also to design the question in a way that they don't just answer the same thing. 3, neutral, every single day, right? Because that's just what they do. So it's an ongoing process. But I think it's fascinating. And if we could hook them up to sensors and monitors and not necessarily going to measure directly their emotional state, but it might, measure their heart rate variability or other things, stress levels, then we could create a time series of data in that. But what we're really looking at here is trades done on a end of day basis rather than every little thing you do intraday, which is more the realm of day traders.
Prang, I hope that answered your question there. There's an anonymous attendee that obviously doesn't want to speak live, who's just asking, I think, kind of on a similar topic here, about how you deliver nudges and if you've looked at various different methods for doing that.
Yes, I mean, we're very open to looking at more methods for doing it. We've taken a common sense approach and done a lot of testing, on ourselves and on our clients. And this is where we've arrived. I can see a ton of opportunity to make the nudging mechanism way better than it is today. I mean, if you can use machine learning to have it learn your own patterns, and it knows that when you don't answer for 2 days that it needs to tap a little louder or ask you if something's wrong or that type of thing. That's all stuff that's very much in our pipeline to further develop. So yeah, but if you have ideas, don't hesitate to get in touch. I'm very interested in hearing other people's thoughts.
I'm sure you'll have a flood of emails on that topic following this. So Levon, I'm just going to unmute you so you can ask your question. Or you might actually have to unmute yourself there.
Hello, I don't know if you hear me properly. I'm outside.
No, we can hear you.
Hello, thank you again for the presentation. I was wondering if you were providing funds or maybe if you had your own R&D department for innovation with complementary data that you could add to your expertise?
Yeah, that's a good question. So we don't provide funds for external research projects, but that's because we're not a profitable company ourselves. So we spend all of our funds on trying to fund our own research projects. But the vast bulk of our organization is one big R&D team, and we do experiments. Particularly, I mean, the complementary data one is particularly interesting. When I first started Essentia 7 years ago, I love wearable technology, and Jawbone was the thing at the time. And I was like, oh, it's so great. We can hook up your Jawbone to Essentia, and you can figure out if you've slept a certain number of hours, is that predictive of you making better decisions or done a certain number of steps or whatever. And what about the weather? I mean, it's pouring where I am right now. And I remember at the time when I was a fund manager, just thinking, if somebody would just tell me, you always make bad decisions on Thursdays when it's raining, like, fine, just tell me that, show me data that proves that. And then just won't come to work on Thursdays when it's raining. Like that, everyone's a winner out of that. If there was the ability to connect the dots between the data on all the different contexts, you've got your emotional context, you've got your market context, you've got the environment that you're in, the sound, the heat, the weather, there's so many other things that are likely to be affecting you. And if we could connect all of these dots, that would be fascinating. So if that's an area that you're interested in and you want to talk about interning or something like that, then definitely drop me a line.
I think that's certainly an incredibly interesting area and a very unanswered question in the field, environment and behavior, their interaction. Sana, I'm just going to unmute you so you can ask your question because I see you've got your hand up, and then Claire will let you go after that.
Hi, Claire. Thank you so much for a really informative talk. I just had a question about how you deal with resistance within the industry to kind of engage with kind of the insights that you're providing, because I think in Thinking Fast and Slow, Daniel Kahneman talks a lot about how that fund managers and kind of investment, it's kind of seen as like an intuitive field. And so when he kind of started finding out a little bit more about how the intuition that people thought they had didn't actually improve their performance, they were really resistant to kind of that engagement. So I wonder, at the beginning of your engagement with clients, how do you manage that?
Yeah, well, that's changing. Like, that's the good news. I mean, there's a new generation of fund managers coming up through the ranks, right? And they've been doing degrees like you guys. They understand that intuition is not an investment strategy, and that it's possible that intuition is helping, in the context of your process, but it at best has a small role to play, and that actually humans are biased, and you are not perfect, and all of that stuff. So there's a waiting game to be played. Let the people that still think it's all about them age out of the system, and let the new blood come in. But actually, in the meantime, it's not just about age. A lot of it is, I think, about personality type. And that's a whole nother area of connecting dots between personality type and behavior. But people who are, we would say, skilled but humble, it's a certain type of person that's willing to look in the mirror and is secure enough in themselves to know that if they see things that are not exactly what they wish they would see, that it's not going to undermine them completely. Those are the people that we want to work with. And I've learned the hard way over the years that, knocking on lots of different fund managers' doors, when you encounter the guy who's like, no, I think my intuition is great, or I don't need this, I perform extremely well. Or sometimes, I get it, I hear what you're saying, but I don't want to know because I think it's just going to mess with my mojo. Your mojo? Mojo is not, that's not an investment strategy. Do you tell your investors that that's mojo, really? So I just stay away from those people because I think my return on energy expended is very low in dealing with that type of person. And there's more and more of the other type of person, you know, coming up every day. So when you're dealing with some of these very large fund management firms, which is where you want to be if you're a vendor of this sort of thing, because it's very expensive service to provide. You need the client to be able to spend a lot of money on it for it to make any sense. And those are exactly the organizations where you have the most sort of stubborn and closed-minded people typically. So then it's about figuring out who in this group, there's always one. I think typically there's about 20% of the team who is up for it and 80% who wish that we would just go away. And if you can find that 20% and really turn them into heroes and then, you know, show them the money. As soon as you show them the money, everyone shuts up. And then you get the 80% saying, oh yeah, I was always a big fan of that. Yeah, I've always wanted to do that. And, you know, we just keep our mouth shut or say, oh, that's right. You're so brilliant. That's so good.
Yeah.
You know, you just got to roll with the humanity.
Thank you.
Thank you so much, Claire. It's been really fantastic, and it's really wonderful to see how well you blend the human and the machine. You know, even just in the last comment there, you've got to roll with the humanity. It's like very interesting how that seems to be a running factor through a lot of the stuff that you do at Essentia. So I can see, Jonathan, you have your hand up, but I'm aware of that we've kind of gone 10 minutes over time here. So
I can see one quick question there that somebody was asking if what did I study for my bachelor and my master? I haven't done a master's. I did a bachelor degree in economics. Not only that, we didn't even have behavioral finance in that degree. I did psychology, you know, as a minor, but there was zero connecting of dots that went on, even though the behavioral finance field did exist. So I'm jealous of all of you. I wish I was studying all the things you're studying because it's come a long way.
Great, thank you so much, Claire. Everyone, obviously, you can't clap your hands, but you know, thank you. It's been really, really interesting, and we're really, really happy to have you come and give your time to BIT and the FinTech Society. If you have all enjoyed this, then in a couple of weeks' time, we have Joachim Ledner joining us, and he's going to talk about altering human risk perception computationally. So that'll be a very different but interesting angle in the intersection of behavioral science and FinTech. So thank you again to you, Claire, and I hope to see you all at Joachim's seminar too.